today is about structuring the file, not a guidance or guideline reading. So by end of this training, you'll be able to take a credit report and purchase contract, and within 10 minutes, you'll be able to answer three things. What income we need, and whether this income is provable, or which product it belongs in, whether it's written WVOE or P&L only. So everything comes today is based on NQM funding's guidelines and matrices. So if you have any questions about the details, you can reach out to me or Sydney directly for any updates or numbers updates. So why these two products? Because each of them hangs the entire income file on a single document. On the written WVOE, one form filled out by the employer is good enough. P&L, one profit and loss statement prepared and signed by the licensed professional, tax professional, is good enough. No W-2s, no pay stubs, no tax returns, and no 4506C on either one. That makes them fast and it makes them unforgiving. Every test around that document matters. So that also makes them the perfect place to learn structures. Liabilities are fixed by the credit report, and housing payment is fixed by the purchase price. Income is the only leverage. So you, a loan officer, fill income at the last with numbers we can prove. The point is, when you review the 1003, you need to exchange every missing pieces so that when a structure, senior loan officer or processor comes in, all we need to provide is the income. So this is the way, this is a method and the math behind. So as a underwriter perspective, who doesn't read your 1003 top to bottom, they read it bottom up, qualifying totals first, 1008 first, and then they hunt for the document behind every number. So we are going to build the application in the same order it gets torn apart. So step one, liabilities, always we get to review it first on section 2C and 2D. Every trade line gets a disposition, counted, excluded with documentation by third party, or paid off with documentation. Step two, the real estate owned on section 3. If you have multiple properties, other properties, commercial, you name it, you need to itemize every payment. And step 3, the subject PITIA, proposed payment, built from the real figures, sales price, loan amount, whether it's FHA, conventional VA, mortgage insurance, you need to figure things out. And step 4, asset, funds to close plus reserve amount. Sourced and seasoned, both are countable. And only then, step 5, income. So we solve the minimum income for the file needs. We check the borrower's real documentable income that clears all the conditions on day one, okay? On the QM loans, we review the income first, and then we dive in maximum sales price or maximum loan amount. With non-QM written WVOE or P&L, we go adverse. We review everything first, and then income, okay? That's the discipline. So one formula runs with this non-QM. I use a 43% DTI today because with the pricing engine, anything goes above 43.01, pricing changes. There's an additional 0.625 add-on kicks in. So make sure you use this 43 as a standard. And then when this number changes, we can go up to 50, but let's dive in. This is the required monthly income equals PITIA plus all the other monthly liabilities divided by 43 and round it up. So on the written WVOE file, the answer is a gross salary. On a P&L only file, it's a net income. The P&L has average per month. They use the same formula, but has different meaning. So that distinction is the half of the topic that we covered today. So I want you to memorize this one number. Every dollar of monthly debt consumed $2.33 of your required income, 43% DTI, right? And if the car payment is $550, then you add $1,280 a month of income from your borrowers has to prove. So sometimes you just have to, question yourself. Why 43 when the program allows 50? Because the moment you cross 43 back-end DTI on a primary or second home, the guide shifts and switches the residual income test. and the pricing add-ons. So residual income means income minus all obligation has to clear 1,500 for one person, 2,500 for two, plus 150 for each additional household member. At our under 43% testing that we are going to apply, this residual income test never exists. Don't make things complicated. So anything between 43 and 50, the loan can absolutely work, but it needs to be documented case by case. So on the 1003, we can put how many household members we have. When the DTI is going above 43, make sure you go back to tax returns and put them in. You don't want to make a mistake on that part and then kill the file. Household size on initial 1003, residual, income, and mass must confirm. Under 43, there's no rules to file. So this is how you keep the file clean. So when you look into this, you gotta review this disposition in every line. What always counts as an installment? Monthly fixed installment payment, revolving minimum payment, and if the report shows no minimum, like student loans, or greater than $10 or 5% of the balance, you use these rules, even though it has a no payment, deferred payment option on the credit report. Auto leases always count, whether you have 1 month, no matter how few months remain. You cannot buy a lease out of the DTI. Okay, don't try to make an exception out of it. You're going to make things more difficult and complicated. Student loans count even in deferment 1% of the balance if no payment reports, unless you document a $0 income-driven plan. Support obligations with more than 10 months to run. This 30-day charge card with 5% of the balance, unless you verify payoff funds at the top of the closing funds and reserves. What is example on this? American Express. When the American Express balance is $8,000, you don't simply put $8,000 towards the back-end DTI. You click omit when closing costs and reserve covers this remaining balance. Okay, so that's why sometimes you have to overcondition the borrower to collect the 401k, Roth, or any retirement accounts. On the right side, these are what you can remove, and if the paper in the file as submission, you got to memorize this. 10 or fewer payments remaining, debt paid off at or before closing, document is on a supplement or the CD, certified deposit, authorized user accounts, business debt with 6 months of canceled business checks, like SBA loan payment, commercial conventional loan payment, debt paid by others with 12 months of other parties' checks. If your applicant co-signed for someone, that's okay. Just provide enough documentation, we can overcome. 401k loans. Surprisingly, even though there is a payment, you can omit this payment from DTI calculation. And contingent liabilities with a court order, okay? Without a court order, when you see numbers on the credit report, you have to consider it first. And when the proper documentation, supplemental document comes in, then you remove then. The exclusion list is where the deal is saved. But this excluded means documented, not promised. This is where pre-approvals fall apart. This is where we have 9 pre-approvals sent out and 2 became a problem because our loan officer didn't exclude a documented. They promised and the different document sets came in unwantedly. We don't want to get there. Liabilities, let's dig a little bit more on this. There are traps, 6 traps that you have to know. Number 1 is undisclosed debt. Remember, a written WVOE file hands the underwriter 2 months of a bank statement, usually, right? For the closing cost and the down payment. But what if you wrote a written WVOE showing $8,000 monthly income, but a bank statement showing $3,000 residual income deposits, regular deposits? That will kill the deal. Do not make that kind of a mistake. When a employee gets auto pay on these statements, you have to just be alerted. If it's one more question you have to address and save the deal, can save the deal, go ahead, right? Departing residence. When both housing payments count, unless a sale contract is executed or contingencies are cleared, or you offset with a 75% of the market supported lease. So you live in a house, you're trying to buy a new house. Are you going to use this departing home's rental income to qualify, or are you going to exclude it completely, remove from the picture at the final 1003? It depends on you, depends on how you structure the file from the day one. And collections under 24 months and under $5,000 cumulative can stay open. So when you run DU, you'll be surprised. Multiple collection accounts under $5,000 can remain as is. You don't have to touch it. You don't have to settle it. Beyond this, it's an extra reserve or 5% into the DTI. Again, 5% is the key term that you have to memorize. And every $500 of debt you retire returns about $1,163 of required income. Okay? So whenever a client says, how much do I have to pay off? How much does it change? Back-end DTI, usually at around this time of the year with 7% rate, about $1,163-ish income needs to be used. Let's dive into the housing payment and proposed payment. So PITIA is everything: principal and interest at the qualifying payment, taxes on the sales price, hazard and flood insurance based on the loan amount, and HOA dues, which related to special assessment or any subordinate financing on the subject, such as solar payments. So use a real tax bill, tax certification from escrow or attorney offices, and real insurance code or annual premium quotation. A $200 a month tax underestimate will raise flags and kill the file. Qualifying payment rules, right? So when we accidentally use a seller's current property tax rate for our new purchase qualifying, it's unfortunate. Things happen. But we want to know how we can overcome and resolve the issue when it comes up. So I want to talk about the ARM product specifically. Any ARM product under 7 years, you add 2% on the qualifying rate. When the note rate is 7%, you qualify the loan at 9%. But anything above 7%, anything above 7 ARMs and above, you use the note rate same as the qualifying rate. And asset. When you receive the loan estimate, it talks about the cash to close and the closing cost. Closing cost and cash to close. Two means very similar, but can be defined in different ways. Funds needed at 3-part stack: down payment, closing cost, and prepaid interest, and possibly required reserves, all visible in 1 month of statement and every page dated within 90 days. So if we are missing page 404 with blank, you also need to provide that. Any single deposit over half of the borrower's monthly income gets sourced on a purchase transactions. Gift. Borrower puts in 5% of their own funds, first on the primary, 10 on the second, and the investment. Then everything becomes very easy. There are some products like QM loans allowing you to cover the entire down payment, closing costs, and reserve requirements from the gift funds, but non-QMs surprisingly have a buyer's minimum contribution amount. Your buyer must have your own funds, and additional closing costs, down payment, reserve requirement can be covered by the gift. And this definition of gift must be wired into the title account. So if the reserve requirement is $100,000, on top of sending in the down payment and the closing cost, you have to wire this gift fund to the title of account. And the buyer will receive that $100,000 back as a credit, as a refund. Make sure you deliver this information when you qualify the client. So what counts for the reserves? Bank, brokerage funds at 100%, retirement without withdrawing, crypto at 60%, Coinbase, for example, right? And cash out proceeds from the very transaction. If it's cash out and you don't have any bank statements, assets to qualify, then you just increase the loan amount to fulfill the reserve requirements. A $70,000 loan, because of a reserve of $10,000, may become $80,000 loan transactions because of the qualification. So let's deep dive on the written VOE. This is a product one for wage earners, gross salary on one form. So on the form, you need 685 FICO scores and $1.5 million maximum loan amount, and LTV caps at 80% primary and 75% on the second home and investment. And housing history, 0 to 30 with no late payment, and you have to show the proof of employment history for +1 years and the lines for 2+ years. So if you're working for A company for 1 year and move to B company and we're using this verified income on B, we need to have the applicant work for more than 2 years on this company B and have the entirety of history of 2+ years. And lastly, the program max DTI is at 50, but we are targeting for 43 or below. So please note, we cannot, may not have other active income, such as second job or gig income, kills the document type. Even though your client is driving for Uber and Lyft, please do not mention it on the 1003. And when there's a passive rental income that's showing up on Schedule E, it's up to you. When the credit report shows the mortgage information, you have to disclose it up front. This is the one exception. Employer cannot be a family member or related party. Okay? So when these three rules are applied, then we can say we have a clean file. And who completes this written VOE? It is complete by HR, payroll, or an officer of the company. So it can be president, vice president, senior manager, whomever. It doesn't have to be that specific person. And this person needs to cover the 2 years with a name, position, date, base salary. On the form, you have to provide with specific trail manners, such as physical mail with tracking number, FedEx, or fax, or an email sent directly from the employer's domain. It can be from Yahoo or Gmail. It must be coming from the employer's domain that identifies the person who completed it. A 1005, the form for written VOE, the borrower hand carries into office or one arrives from Gmail address. No go, not possible. Do not make this mistake. And after this form is used, conditional loan approval comes out. At the time of clear to close, we apply this verbal verification once again. Within the 10 business days of closing, a phone number you call must be identified through online, internet, directory assistance, or licensing bureau, like CPA offices, doctor's office. You can't sometimes manipulate. You must use the data that was registered prior to loan application date. Never just the number that you are using on the form, right? On the written VOE, mark the date, and you need to follow through and count every single time so that at the last minute, you don't have to deliver the sad news or blow the file up because of this verification. You don't want the verifier to travel overseas, but you never know what's going to happen. So please be mindful when you prepare these verifiable documents. So I want to apply and teach you these two tests. Test one is a 65% deposit test. 2 most recent bank statement is received. Now you review all the deposits and anything that comes up, you have to document it with a reasoning on the letter of explanation. So why 65? Why not 50, right? Because net pay after withhold it typically lands around 70 to 80% of the gross. So normal paycheck passes this room, right? So when does it fail? Heavy 401k deferrals, garnishments, split direct deposits into multiple accounts you never have provided, wages partially deposited as a cash. If you know it up front, don't send in bank statements and written VOE with different number and expect the processor and underwriter to figure it out. This fix is very boring and time consuming, but this is the most effective way to consolidate payroll deposit the information into one account, or wait another 2 months before you open escrow, right? You need to teach your borrower and the agent how to pivot which document type we are sending the file to. Second test is the SOP through salary.com. Pull the exact job title from the written VOE, from the employer's city and the zip code, and the salary must sit within this published range. Let's say mortgage loan officer, and there is a range within the Fullerton 92835. And our working rule is usually within the 25th to 25% to 75% band. Above that band, income is not workable and not countable. So if let's say, dental hygienist maximum at 75 percentile is at $90,000, and we need to use $150,000 on the written VOE. It's not going to work. Okay, so we don't have to be creative on this. If the number is not showing on the salary.com, don't even question it. Don't even stretch it. We move on, right? Deal. In this case, this is where the deal gets restructured and needs lesser. So when you review, you need to question yourself and answer, is written VOE described as power the same way on the 1003? The answer must be yes. Never fix salary.com by logging in. There is a log that's being, traceable. Don't do that. So example one, we build first and then solve. So let's say this power, operations manager, 3 years on the job, employer is not related. Now, how do we verify it? We receive the employment information. We search through the Secretary of State, and we were confirming the established date of the entity was also 3+ years. Now we're good to go. It was a purchase file with a primary $600,000 sales price, 20% down, loan amount at $480,000, and we quoted 7.5%. Now, build it in the order. Now we know the PI, tax, and insurance because we identify the sales price, type of the home, and the loan amount, and the loan type. And the next question is the liabilities, $550 per month auto payment, and $180,000 and the minimum car payment, credit card payment, and $210 student loan, something like $940. And total obligation now is $5,071. You divide this number by 43%. Now we have the income that we need to use, $11,794. And you round it up. You multiply this by 12 and round it up. Then call it $141,000 a year. We know before anyone asked employer anything, usually loan officers come up and say, hey, processor, can you help me structure the file? And can you let me know which number to use on this file? Now I showed you how we calculate the numbers. So I want you to give it a try. And I want you to come up with a solution and say, hey, can you verify what I did, what I come up with? And then we, we educate the borrower and tell the HR, hey, HR, if HR verifies the salary at $144,000, which is a little bit above than what we actually need, now DTI sets at 42.3%. It's better. Then we move on, right? Conditional loan proof comes out within minutes now after this is done. So the example here on the salary.com showing operations manager that makes about X amount, and the 65% rule passed because of the employer deposit showing on the bank statement was passed. Reserve requirement, loan amount under $500,000, we need only 3 months of a PITIA, which is about $12,394. That was also good to go. All were sourced from one statement. Why do I mention about one statement? QM loans require 2 months bank statement. Non-QM loans require only 1 month bank statement. So if you need to creatively structure the file, deposit everything by end of this month, and then wait 30 days, and then October you open up an escrow with a September bank statement that is very clean and pristine. This is a counter structure that we need to know and we understand. What if the HR comes up with $132,000, way less than what we actually asked for? Then the DTI becomes 46% over the target. So the extra testing, residual income test, needs to be applied. It's not a dead deal. Your pricing gets jeopardized and your qualification details also get jeopardized. What if the residual income test doesn't pass, right? So these are the red flags that we see the written VOE. Related employer, same last name, similar last name. Now, Fannie Mae, since last year, is teaming up with Palantir. May 2025, all the database from Fannie Mae is now shared with Palantir, which means all the audits are being done by the AI system. There's no human work. There's no manual work anymore. This is why things get very tricky and difficult. When we pull the borrower's credit report, there's an employment history and the address that this person was living for the last 10 years. If any of these addresses match to the backend servicing or LexisNexis, the secondary audit system, then at the 11th hour, on the day of funding, there's a chance that we have to kill the file. I said this upfront. When you know the employer and the borrower knows and related, don't submit the files. Don't go through the headache. Don't even build issue within our firm. I said it very clearly, no relationship within the employer to employee. There's no cure. That's why. There's no other way. And any active side income, don't send us. I don't want to know. Processors and underwriters don't want to know as well. When the title or salary outside the band on the salary.com doesn't match, a salary that lands suspiciously exactly on the required number. Let's say we need a $5,000. We have to calculate the after tax. So it should be something like $3,800. But if a $5,000 flat deposit is coming in, that's another flag, right? That exact required number depositing on the bank statement is also a flag. Underwriters notice it right away, and it's going to create another issue, right? And housing history. Never put W-2 tax returns on a return WVOE file. Don't expect the processor what to submit. We loan officers need to learn what document to submit, okay? This is why Sydney and I are running the scenario desk is for, right? If you know that you submitted it, make sure submission desk doesn't submit it. I am not going to train my submission desk to be aware what to submit and what not to submit. If a file denies because of lack of delivery, lack of understanding, you need to come up and ask. It's unfortunate part on us that we have to sometimes kill the file because of a misleading information or misunderstanding. But this needs to be done. Documents that are not required, don't submit it, please. Okay. And second part, the P&L only. Self-employed for the qualifying number is a net, not a gross. So this one is a little bit difficult than written WVOE files. Minimum credit score is at 700 and all the borrowers. So I'm not going to mention about the lender or Carrington's 625 score P&L product. I'm specifically talking about the underwriting programs that we do in-house today. All borrowers must be 700 plus, 680 co-borrower kills the P&L only. Even the primary is at 780. Whichever one is lower is identified and being used. And $1.5 million cap still applies with 80% LTV for the primary, 75% LTV for the second home and investment. 2 years in the same current business, same information, an 18 months flex option that exists, right? But don't even consider it in the beginning. Right? It doesn't apply here. The P&L covers exactly 12 to 24 months and is dated within 90 days of the application. So the rule that we want to apply, the rule that changes how you pre-screen exceptions are ineligible. On the most programs, a near miss gets an exception request. On a P&L only, there's no ask. There's no exception. If the credit score comes in at 699, don't ask. If the DTI goes above 50.9%, don't ask. The file fits in the box or it isn't. So the preparer loan officer is the program guru who needs to educate our partners like CPA, EA, and PITIA licensed tax preparer. Because we need these people's prepared P&L dated and signed and attested that they prepared that our most tax returns is prepared by those people with a CPA letter or tax professional letters. Borrower prepared, bookkeeper prepared, or spouse prepared, unlicensed individual prepared P&L are not countable in this case. So qualifying income is the net income on the P&L divided by the number of months. So add back are the closed list: depreciation, depletion, amortization, and casualty losses. What are they? If you don't know, don't try to learn it. Immediately give a call to CPA, EA, and then deep dive within the file together. Your assumption will be and can be the reason file is dying. There's no, so that's it, right? No owner salary add back, no one-time legal bill, repair cost, right? If the borrower owns less than 100%, multiply by the ownership percentage after all the calculation is being done. Now, the rule that rewrites Lean's P&L, the 20% expense factor, right? The guide expects a real business to spend at least 20% of its revenue. Show less. Then the underwriter recalculates net income at the 20% expense level, which means qualifying income can never exceed 80% of the gross revenue. Whatever the P&L says. Again, whatever the P&L says. There's no comparable information like return VOE file. Whatever you put in is considered. So the work backward before you order anything requires 43% DTI showing P&L times 12, right? So some investors ask for the year to date plus previous year's full year P&L. Some investors are asking for most recent 12 months. Depending on how you structure the file, you got to apply these small tests. So what does it mean? So net income is the total obligation over the 0.43 times 12 is what the annual P&L must net, right? Divide that number by 0.8 and you get the minimum revenue for this deal implies. So let me give you an example. This client, 100% owner of the logistics company, 4 years in business, credit score for both applicants were 722 and 748. Both are above 700, so we're moving on. We have a clearance. Now it's a purchase transaction for primary. Sales price is 750, 25% was down. So loan amount at 562,500 was accounted at rate at 7.75. Now we know the principal and interest because we identified the loan amount and the rate. We identified the property tax of the sales price and insurance by the loan amount. So record net on this case would be $13,826 a month, right? So if you see this number and the workflow, you'll be able to answer the question and qualify and issue pre-approval letter faster than the QM loans. That's what I like about the file as well. So this same deal, different P&L is explained in this manner. The slide that I want to cover today, this one, someone who knows what to do, but who didn't know fully in depth of how this product works, accidentally sends the file at 44% DTI. With the same rate, you're losing about 100 basis points because of one mistake. You may say, Peter, it's only $1,000 a month. How different can it be? It can be very different, okay? With the previous example, because of $1,000 monthly income difference, now you just have wasted about $5,600 lender credit that you were able to give to the borrower. So never ask the preparer to adjust the expenses. You figure it out. And if you don't know, that's where Sydney and I come in. We'll help you to structure the file on your behalf. We'll triple check for you, but we don't want to say sorry at the last minute. So before submission, verify these things and the business. The one CPA, you go to cpaverify.org or state board, right? PITIA in the IRS directory. There is a attestation that you can find online. So let's say Peter Kim, CPA, signed, tested the file. You search up Peter Kim, and if he has an active license, at which state, right? If a CPA letter shows CPA California firm address, but the license is in Georgia, no, it's not going to work. So make sure you also verify once again. Don't rely everything on the third party because your client relies all on you. So you have to know what you're doing. And the business itself verified as active within 30 business days within the closing, right? And the ownership is under 100%, then the CPA letter or operating agreement that needs to be documented. Secretary of State, Licensing Bureau, and inner listing all needs to be showing. And when you prepare the file, you have to also let them know the P&L and the CPA letter or EA letter will be verified verbally, and time to time, they will send this same document via email or fax to make sure the CPA or EA, sent these documents on behalf of the loan officer and the borrower. These correspondent transactions, whether it's a wholesale file or a correspondent file, routinely make the same call. So when a CPA, after sending a document, is unreachable at conditional stage, that means we can conditionally approve the file. If no one verifies what documents were used, that's also a deal killer. So these are the red flags on the P&L loans. When the core borrower is under 700, when the established date of the business is under 2 years, when stable or odd period of P&L, 9 months is not a full thing. Either most recent 12 months or previous 12 months, and the year to date. You pick and choose which investor you are going to send it to. An unverified preparer information, CPA, EA, PTIN, if the license number is not identified. If you Google search this is what we had before. This CPA was hired by 2 different agencies. So when we were Google searching its license number, A company popped up. But on a CPA letter, B company was popping up. So we had this verification issue and we weren't able to fund the file for, I don't know, it was taking about a month just to verify these numbers. These are online directory information. And expenses under 20% that nobody talks about, but you have to know. Creative add backs, revenue out of the scale for the shop, a rental vehicle, let's say auto shop making like $7 million a year. Doesn't make sense unless it has a multiple location. It needs to make sense. Tax return slips into the file, or K1 showing ownership slips into the file also is a reason to kill. Anything that needs an exception, because there's none. Don't expect an exception on P&L files. We have to just know a little bit more than other. Reserve requirement, I want to talk about this. Reserves are the months of a subject PITIA, and there are 2 tiers. Loan amount of $500,000 at 80% LTV or less, 3 months. Anything else up to $1.5 million, 6 months, right? So if the loan amount is $500,001, then we need 6 months reserve. So when you price that, keep that in mind. When we are dealing with a multiple property applicants, investors, then high is a single requirement, not a sum. It's a cash out proceeds. Focus on those towards the reserve, and gifts cannot be considered, cannot be acceptable. Retirement and brokerage count without liquidating, right? So unlike the other files where we have to liquidate to consider, our non-QM product does not require liquidation. What happens when we liquidate them? Capital gain tax comes in. You don't want to talk about that. You don't want to get there. So which product and when to pivot? The pivot decision happens in the first conversation of 2 questions. How are you paid and what does your housing payment look like? Is it salaried, clean history with 1 job, then written VOE? Salaried but needs a side gig to qualify, not a written VOE. Sometimes consider personal bank statement product. You'll be surprised. Written VOE applicants apply with personal 12-month bank statements. And if we are talking to self-employed, then talk to a solid CPA, EA, P10, create a P&L prepared by them. Lean expenses under 20% and compare with a bank statement pricing with P&L pricing, because this floor will cap you at a certain point. Core under 700 scores, don't even consider P&L. Immediately go to bank statement options. And when the loan amount is greater than $1.5 million with no housing history, such as rent-free from their family members or need an exception, it's tricky. You have to be knowledgeable in that specific categories. So what can be the guardrail? So let me say the compliance part of the way underwriting here is, so solve for income number is a feasible, right? 43 that sharp backend DTI is a workable way to do it, but we don't recommend it. It needs to make sense, reasonably make sense. When the written VOE stage, the salary of the employer exactly and actually pays, a P&L reflects the preparer's actual figures, salary.com, the 65% deposit or verbal VOE, CPA attestation, exists to catch, the number that doesn't match the reality. So Giving Tree Lending underwrites a file and runs a zero tolerance fraud policy. And a file that fails these tests does not die. It burns the borrower, your pipeline, and your relationship with realtors. So here's the positive version of the same sentence. When the real number misses, change the deal. Instead of doing something else, you change it. Pay off the debt. Every dollar of the payment buys back $2.33 of the income. And more down, lower price points. As the down payment increases, the loan amount decreases, DTI can also work. So a different doc type also can be considered. Okay. So takeaway for today, recap for today is a structure the file so the income you can prove carries a deal at or under 43% DTI, right? You have this, checklist and the calculator that I'm going to share today, which will help you to identify which document type, which loan product, which investor to send the file so that you don't have to restructure the file after escrow is open or file is open. Let's take a look. So this is the calculator that I'm going to share after training is done. We're going to embed this into ERP. So sometime this week. So let's say $600,000 sales price at LTV 80%. This is also changeable. If you change the LTV, the numbers will shift. Okay. Primary, you can do selectively with second home or investment, rate is 7% or 6.5% or 8%, whatever the number you need to plug in, you plug it in. amortization from 15 to all the way to 40 years. And these numbers are pre-fixated numbers, but you can change it to 0.9, 2.0 if it's Texas, or new built condo with Melrose. I'm going to put the traditional 1.25, homeowners insurance based on the loan amount, 0.37, 0.35, 0.4, whatever the number you need. And HOA, 400, 500, whatever the number you need. And then mortgage PMI, when the down payment is under 20%, and when we're applying for FHA or VA, for FHA, you need to do it. Unless we have specific exceptions, we're not going to have a monthly PMI for non-QM conventional, written VOE, P&L, and others. Let's say PMI is 0, monthly liability, car payment, credit card payment, student loan. Back at DTI 49%, then you have these numbers, right? So at $9,656, we have 40% DTI. But you can also change it. Let's say when you check this number, sales price is now updated. When you say 90%, this person wanted to down pay at 90. And if you look into counter approval section, when you fill out these targets and actual and program limits, at max loan amount, max sales price, these are the options that we can consider as well. So this cash to close depends on these numbers. Okay. And written VOE, like I did before, income is the last question that we're going to ask. DTI caps at 43, FICO score is at 720, household at 1. Then we don't have to run the residual test. Let's say income at whatever, and we're doing 41%. Do you see the DTI that's changing? So P&L as well, along with DSCR, we will offer interest-only option as well, or target DSCR at 0.8. Then the counter approval section will come up, 1.5. Do you see the income that's changing right here? So when you play around with this loan pricing calculator, qualification calculator, you'll be able to dive in the results and the outcome a lot faster than what you were doing before.